Some trends that we've seen in the world in terms of 1031 exchanges, our transaction volume is down a little bit, but not a whole lot. So we're starting to see kind of a, if you will, a normalized market. I think that frothiness is kind of going away, and the transaction volume is kind of coming down. We are seeing a lot of people who are selling in California and exchanging out of California. So I think Bruce said about 30% of the people who sell go out of California. We've certainly seen that. It's getting out of the frothy market, and it's something that pencils out and has more income and cash flows better. I'm assuming that we're probably all California taxpayers. So with that, those who 1031 exchange out of California, so you're selling rental property in California, you structure a 1031 exchange and you acquire replacement property outside of California. It's still tax deferred because you've done the 1031 exchange, but California has this wonderful thing called the California clawback. How many people have heard about the California clawback? Not as, maybe 20% or so. The California clawback is actually, that's the nickname we've given it. But California takes the position that you've sold in California, you've done an exchange, you've acquired out of state. So it's still tax deferred, but in the future, if you decide to sell and cash out and pay the tax, that's when California wants their quote unquote fair share. So it's what they call the clawback, where they reach out and claw back their fair share of the taxes. Not a huge issue, except you just have to be aware of that. If you keep exchanging throughout your lifetime, you will never pay taxes. As long as you keep deferring the taxes, California does not get anything. If you pass on, whoever you leave the property to gets a step up in cost basis. So that's a nice way of saying the capital gain tax, the depreciation recapture tax, all of that goes away at death because you've left it to your heirs. So you get the step up in cost basis. So California will not get their fair share in that case either. So the only time California gets anything is if you sell, cash out, and pay the tax. The other requirement built into that is every year you have to file as part of your tax return an information return that updates California on the status of that property. So they now have put in a tracking or monitoring mechanism so they know what the status of that property is, which means they can keep an eye on you. The other trends we've seen about a 450% increase in reverse 1031 exchange transactions. I'll talk about that in a minute, but that's kind of a factor of the market. We've also seen a fairly significant increase in the number of 1031 exchanges that involve foreign property. So for those who have rental, investment, or business use property in a foreign country, that can be sold and you can structure a 1031 exchange as long as you exchange into another foreign property. So it does have to be foreign property for other foreign property. You can't go from foreign to US or from US to foreign.